Welcome to MarketTamer.com. Let's follow up on yesterday's discussion of market action. We noted yesterday the futures were pointing lower, and that even though it was a triple-digit decline in the futures ahead of the open, that wasn't necessarily going to impact the trend as it currently stood, which was bullish. And as the day went on yesterday, we found that the market initially stayed somewhat range bound and then closed near the lows of the day. In fact, we can see right around here, this is the market, this is the Dow Jones closing down about 155 points. What's interesting though is this decline still hasn't done anything to the trend, and the way to quickly determine that is just look at the direction of the moving averages. The 5-day is flattening out. The 20-day is still pointing higher. As I mentioned yesterday, it's the 20-day that we're going to care about during this trend, since that's the one that has held at multiple points on this rally higher. However, with all that said, we also pointed out that we're increasingly cautious as we go higher and higher. There was a great interview yesterday on CNBC with Meredith Whitney, and she was talking about how there really is no fundamental justification for much of this rally. That being said, we also pointed out a few weeks back that there was a paradigm shift. The government was intervening, and so this rally could sustain a lot longer than people might expect. And I think that's already true, and it might continue to be true. So we're not going to take aggressive preemptive action until we see really a correction take place. With that said, we can certainly look to position ourselves in the event that the market starts to consolidate here, or turn over, or even move slightly higher. The one thing we're not expecting right now is a very aggressive move to the upside. And that being the case, one of the strategies that would work well is a bear call at higher strikes. So as I bring this in, I'll just remind you all that nothing that we discuss here constitutes a recommendation to buy or sell a security. Obviously, all trading is designed for educational purposes here and for your own risk tolerance. So with all that said, let's jump to research in motion, which Ron suggested to me was a candidate for an interesting trade. And obviously you can see what's happened. Research in motion, it's been exceptionally bullish. It's in fact doubled from the March lows to its current point, and has pulled back slightly here. So Ron was looking at a potential bear call at higher prices, and one of the interesting aspects of the bear call that he was looking at is it has quite a lot of premium at higher prices. For example, with the stock currently around $73, he was looking at strike 90 short calls. So if we're looking at a move in the stock price from 73 to 90, that's approximately a 23% move higher. And even if the stock moved 23% higher, having already moved 100% higher in 2 months, that would be a very, very substantial increase over the next 38 days. We can see the premiums are pretty good. $1.57 on the strike 90 short call, 101 on the strike 95 long call, so 56 cents of premium and 4.44 of risk, which is not a bad risk to reward trade-off. The one thing to pay attention to is earnings. We know there is an earnings announcement in June, but obviously we'll talk more about that in the member forum here. So with that, look forward to chatting with you in classes.